Amit Chadha, the company has maintained the revenue guidance at what, 13.5% to 15.5% for this financial year. What should the markets be factoring in? Double-digit revenue growth after that in FY24. All of this against the backdrop, of course, of the ugly R recession word in the US and Europe also coming into a slowdown.
So I do feel fairly comfortable that, and again, I'm not providing a revenue guidance for next year, but I do believe that double-digit growth should continue as we move forward, and that's what we are planning for.
Now, all IT companies, of course, have been struggling with wage labor costs, attrition, from the likes of TCS and HCL Tech also. We've been hearing of figures about 20%. What has all of this done for your margins? Should the markets pencil in, factor in 18% going forward?
Our increment cycles are effective July 1st, and our employees have been handed out the new letters or will be handed out letters in the next couple of days. By Tuesday, we plan to close it. So there is definitely a charge that we will get because of increased labor costs. But having said that, we do have some avenues in terms of utilization, in terms of pyramid, in terms of offshoring, and in terms of the larger contracts that we are winning at better margins. So we work in progress. The quarter is not done yet. Our aspiration that we yesterday announced in the earnings call as well is to stay in the 18% EBIT range in the medium term. And that's where I'll leave it. But of course, the quarter is not done yet, work to be done. One more thing I'd like to bring out is, and we talked about the demand picture, we've had the best possible quarter in terms of deals. So we didn't sign a 100 million deal this quarter, but this quarter was a 50 million deal in aero and rail. There were 4 deals that were more than 15 million in automotive, high tech, and sustainability, plant engineering, and 2 deals again in automotive. So I do believe that some of this will help us as we move forward in the quarters ahead.
Right. You talked about the deal wins. Tell us a little bit about how the overall pipeline is, how the momentum has been shaping up, and also whether these deals are now coming in at better pricing.
So the deal pipeline today is higher than what it was last quarter. We continue to work on it. I'd like to actually mention our teams continue to ideate for our customers, putting their customers in the middle of it, create proactive deals, etc. We are right now pursuing a couple of largest contracts in Europe in automotive as well. There are contracts that are being pursued in the US, in oil and gas, in IP, in digital transformation. So that's all work in progress on a daily basis. Given the deal momentum I have seen, I do believe that this deal momentum is sustainable and shall continue for the next few quarters.
Right. I also want to talk about the headcount trends and whether or not there are any signs of attrition moderating finally. And also when it comes to offshore and onshore mix, that looks like, it's a little bit skewed towards onshore versus the peers. Is that likely to change or not?
So the first answer in terms of headcount, we've been able to add about 550 people in the quarter. Net headcount increase. Attrition is about 23.2%, so it's gone up, but it's still lower than peers. I do believe that I'll need another 2 quarters to get attrition back in the teens, right? So I need 2 quarters to do that. We've got various measures, not just compensation increase and corrections, but trying to build out on the aspirations of our employees. Because when a company grows, it provides avenues, it provides opportunity. And I do believe that if we can provide the opportunity to our bright and young engineers, we can create magic. Right? So I do believe that. Now, if I go on to offshore-onshore ratio, our offshore-onshore ratio currently is about, so revenues are about 56% offshore, 44% on-site revenues. I do believe that we could potentially go up to about 58% offshore as well, right up to 60% offshore can happen, is where we can accelerate. But again, to be seen, like I said, the quarter is not done yet, the year is not done yet. I did say it yesterday, I'm saying it again, that, we had given guidance of 13.5 to 15.5 in dollar terms at the beginning of the year. I'm reconfirming that guidance. In fact, I'm saying that if it was constant rupee to dollar, constant currency as of quarter four, I would actually say we'll be at 14.5 to 16.5%. Right. Second, I do believe that we will hit the $1 billion run rate between quarter two and quarter three of this year. We had guided that last September. I maintain that. Lastly, we had said $1.5 billion by one of the quarters in FY25, and we are retaining that as well.
So you have cash of about 2,200 crores on the books. How are you planning to use it?
Yes. So as you've seen our past, we continue to evaluate and look at companies. Our last acquisition of Orchestra Technologies has been fairly good for us in the 5G space, and that was done about 21 months ago, right? And that gives us the confidence to continue to look. We are looking for ISV, high-tech space or med-tech space asset in the US or automotive asset in Europe. Now, these have to come at a reasonable pricing, and we continue to look and evaluate. We are looking to see if we can get something between 40-ish, 50-ish million dollars to up to about $300 million range, if we can find an engineering company that fits in. And there are various conversations at various times. In fact, like our sales pipeline, we continue to have a M&A pipeline as well, and we have a full team working on it. I am hopeful that we'll try and do something in the future. I don't want to put a time to it, but that's an active progress that we continue to make in that area.